Dana has been in the retirement plan industry for over 25 years and currently serves as the Regional Sales Director for the Dakotas Territory. He is the former president and CEO of Retirement LLC that joined Definiti in April of this year. Now, I know that Dana and his lovely wife, Nancy, recently celebrated their 30th anniversary, and they are also proud parents of twins who are both in their freshman year of college. Today, Dana will share how a cash balance plan with Definiti can give your clients some unique retirement savings opportunities. Welcome, Dana. The floor is now yours.
Oh, thank you, Sandy. That was a very nice introduction. Appreciate it. So good afternoon, morning, I guess, wherever you're located. It's great to be with you here on our third and final day of the Definiti Retirement Academy. I get the pleasure of introducing cash balance plans in the short time that we have. And really what I want to do is provide you some really key topics that are often questions that we get from our advisor partners. So whether you've had an opportunity to work with cash balance plans before or they're new to you, I'm hoping that we'll have something here that will be of benefit to you. So let's get rolling. First thing we're going to do is talk about the fact that cash balance plans are often referred to as a hybrid plan. And the reason they're called a hybrid is because cash balance plans offer the characteristics of a defined contribution plan and a defined benefit plan. So what we mean by that is a cash balance plan has all of the flexibility and the portability that you would normally associate with a defined contribution plan, like a 401k plan, yet it has much higher contribution amounts that you're familiar with a pension plan. So you really get the best of both worlds. The other thing is that a cash balance plan is named appropriately because the participants' statements are presented just like a defined contribution plan as a cash balance, hence the name. So you have a starting balance, maybe zero if it's the first year, but we've got new contributions, we've got the investment earnings, and then the ending balance. So when you think of a pension plan, you might think of some future accrued benefit at time of retirement based upon these actuarial calculations. Well, that's all here yet, but it's presented to the participants as a cash balance, like a defined contribution plan, which makes it much easier to explain to potential clients and also to the participants once they are given the opportunity to be in the plan. Guaranteed minimum benefit. So participants in a pension plan, like a cash balance plan, are guaranteed a minimum benefit. And it's based upon a formula. And the funding formula has typical factors that are based upon age of the participant, their years of service, their past, present, and future earnings, if we know what that might be. So this formula structure really benefits older employees, higher income earners, those with longer service, which is really the definition of the business owners. And so what we're able to do is create a targeted benefit for the specific people that we're trying to provide this maximum benefit for, and then the rest of the staff will get a meaningful benefit as well. But we can really target this to key individuals where 80, sometimes 90% of all the contributions are going to the key individuals, the business owners or the partners of the firm. So let's talk a little bit about the investments, the rates of return, and then your compensation as the advisor. These are really important topics, and they're really not that complicated when you boil it down. So first of all, the assets are held in a single pooled account for all participants. So that provides simplicity for you. You have a single account for the plan. You're going to get a check from the employer generally once a year. And so it's very easy to manage because you don't have these individual accounts. The rate of return is a guaranteed rate of return generally. It's defined as an interest crediting rate. So this fixed rate of return is defined in the plan. However, it can also be a variable rate of return, what we call a market rate of return. And whether you do a fixed rate or a market rate of return is really dependent upon your client, the risk tolerance, and that's a conversation that we can have with them to determine which would be the best path. Market rate of return, a little bit more complicated, but it's certainly something that we at Definiti can provide you. But ultimately, the employer is responsible for the investment risk. And so a fixed rate of return, generally around 5%, is very, very common. Now, often we get asked by the advisors is, how do I get compensated on this? And you get compensated like you would with any other type of investment or client that you have. That is between you and the client. And so these assets can be held at a brokerage account with your firm. They can also be held at one of our record-keeping partners. So you determine your level of compensation. We stay out of that, but it's very similar to what you would have with any other client. Portability. So the life cycle of a cash balance plan in the industry is on average 7 years, but they can run as short as 3 years. They can run indefinitely, but 7 years is not uncommon. And so the question comes up is, what do we do with the assets once the employee leaves or we terminate the plan? And there's lots of different options. You can do installment payments, but a lump sum distribution is available. But the most popular by far is that each participant would take their assets in the cash balance plan when they leave or when the plan is met its goals and is terminated. They would roll that money over into an IRA. And the beautiful thing about that is it preserves the tax deferred status all the way up until the time that they need to take RMDs. And so the other nice thing about that is that you can retain the assets when they go from the cash balance plan to the IRA. So you've helped them build this nest egg through this cash balance plan, and now you can help them as they're utilizing that money in retirement or as they get close to retirement. So that's a little bit about portability. Higher compensations. This is based upon the 2024 limits that was just released by the Treasury Department a week or so ago. And so in a defined contribution plan like a 401k plan, the maximum contribution for 2024 is going to be $69,000. If the participant is age 50 or above, so they're catch-up eligible, they can put another $7,500 or $76,500 if they have the income to support that. In a defined benefit plan like a cash balance plan, that limit goes up to $275,000. And if we do a combo plan, a 401k and a cash balance plan, which is very, very common, we can get those limits up above $300,000 potentially. But it's all based upon that formula that I talked about: age, years of service, compensation. So they have to have those parameters to support that. But if it does, we can obviously put in a lot of money and really help these individuals that maybe have not been saving for retirement because they've been running their business, and as they're getting close to retirement, they're trying to pack in an entire career of retirement in a short period of time, and this is the way to do it. So how do you determine good candidates for a cash balance plan? Well, the short answer is you just never know. It could be anybody. I'm always surprised by the business. Any type of business that you have high income earners, it can work really, really well. But your typical go-tos are going to be your medical practices, your legal practices, accountants, engineers, any type of professional service. Those generally work really well, help them build retirement wealth at a tax-advantaged product like a cash balance plan. Business owners who have uneven income actually is another way. So the nice thing about a cash balance plan, that formula is based upon their earnings. So when their earnings go up, that contribution amount goes up. And if earnings go down, it can go down. So it ebbs and flows with their earnings. So individuals like farmers are great candidates, especially as they're getting closer to retirement, because they often don't have the same inputs into the farm, but now they have all of the income and they have no way to defer that income. And a lot of them may have grain and storage. Run into a lot of farmers that have millions of dollars in grain. And what we're able to do with these, with a cash balance plan, is allow them to take that grain out over a period of 3 to 5 years, convert it all into the cash balance plan, defer taxes on it until they want to. So that's a little bit about the candidates, but really the best way to determine a candidate is to reach out to your Definiti sales consultant. If you can get the census data to us using that census template that we can provide a free plan design illustration. And those illustrations really shed light on the potential and the effectiveness of the plan. It's really a great way to communicate the plan. So we partner with you to help you earn the trust and ultimately the business of your client through that process. We have lots of resources. We have materials to help your clients and you understand the nuances of a cash balance plan. We have case studies, but really these individual illustrations are a specific case study for the client, and we'd be happy to do training for you. We have cash balance presentations that we can do for you and your entire team at your office if you'd like to take advantage of that. So how do you take advantage of that? Simple. You just go to definiti.com/sales. You'll get a nice little map of the United States. You click on where you're located, and the contact information of your sales consultant will pop up, and we'd be happy to help you through the entire process of a cash balance plan. So that's it. Hopefully that was helpful. Please lean on us. We're here to help you learn about these plans and hopefully add them to your block of business. So thank you very much.